computer. Well, and I'm going to share my screen. And let's just get going. Good afternoon, everyone. Um, I'm going to assume that you can hear me. and we are on week 11. Here's our outline. And what we plan on doing today is just going over notes, our asset tracking, midterm, homework 9, and then talk a little bit more about these other topics. So we're going through this. If you got any questions at any time, stop us. Let me get the chat up here in my box so that I can see it. And we'll be on our way. Just a note here. Notes. No more homework. We've done our last homework. So with that handed in, that we will complete that. That homework is now done. And we're done with homeworks in this course. There is a final asset tracking that is due on December 1 at midnight. So that's after our midterm break. And we will be putting a module on what we want in that up. I'm going to go now to our Compass screen and just show that to you. No, that's not the one. Which one is it? This one. So if you look at our website right now, here's our week 12 lecture discussion, November 17th and 19th. This is the material that we're going to use on this class. Here's where we will put all our modules, and we will be putting those up here, and they will all go on here. And I just named them online modules, November 17th till the end of the semester. And we will just put all of our modules and everything else right here. So any of the online modules and material that will go here will go here. We will definitely do our final asset tracking. We will have a project. Our project, we will put more material there. I am going to be putting up there an example of the completed project, and I almost have mine done. And then we will do other assets other than equities and debt. So all those online modules will be here. After the semester, we will have 3 online sessions. And so this is Tuesday, Thursday, and Tuesday again. All 3 of these are going to be a bit different. So if you could, I would suggest being on the Tuesday session. And if you want to be on that live, that's fine. If not, we will put a recording here just like we've done the others. So we'll have online recordings for December 1st, 3rd, and 8th. And that will then complete our coursework. So remaining material will be up here, online modules, Zoom session December 1st, December 3rd, and December 8th. All right, questions or comments? So that's where all this material is going to be at. Okay. I'm going to stop sharing this screen and go back to our outline. All right, so let's continue the notes. So our final asset tracking is due December 1 at midnight. Again, we will be putting our asset tracking back up there. We will have Zoom sessions at the break, December 1, December 3rd, December 8th. I showed you where those links will be, and the modules will be recorded there as well. We've already mentioned this, but the project will be due, the final project will be due December 9th at midnight. And again, I am going to be putting up a handout or an example of a completed project, and you already have the instructions, so that should give you some pretty good ideas about what to do there. We will talk about the project as well in a number of these Zoom sessions coming up. And again, there will be modules up there as well. So that will be, if you want to review, put the item up, put your project up there for review. I will review it, provide you comments, and then if you get it to me by December 4th, be December 9th, you can have the final project will then be due. Final thing is the final, and this is going to be the same. It's going to be the same format as the midterms. You will be able to take it during finals week, and we'll show that material to you. And again, it will be the same format as our 2 midterms. So, and we'll have more information about that coming out after the break. So that's our outline today. Enrique, have I missed anything that I should be talking about?
No, I don't think so. No.
All right. Then we'll move on here. And again, go to the webpage for more information on asset tracking and final project. All right, while I'm going over it, what was your big news this week? Give me some ideas of what your big news was this week was on your asset tracking. What did you tell me about this week on asset tracking? Type that in the chat if you wouldn't mind, and we will go from there. Yep, vaccine. Yep, right. Don and Cam. Vaccine hopes are high. Yep. All right. So, and again, you're exactly right. We saw the S&P 500 go from 3509 to 3585. That was a 2.16% increase. That was a combined with that 7.32 increases before. Our 10-year Treasury note went up a little bit as well. Again, if you're looking at these 10-year Treasury note yields, there's not much going on there. I highlighted, or I put on our website, and I'm going to share this again. I'm going to go back to our website. I'm going to go back to Safari. And I put 2 articles up there. And the first one was this one, obviously, COVID-19. The U.S. election and the good early results from the COVID-19 vaccine. So that was the same thing that was rated or mentioned by both of you. Also, I wanted to again note, I'm sorry. Borrowing costs have tumbled for a host of junk-rated companies such as American Airlines, Macy's, Occidental Petroleum. So, this one I put up there based on the borrowers. And again, the yields on these bonds have been falling. And again, so which is somewhat ironic right now, right? We have COVID cases spiking, but the yields are coming down, and people are betting a lot on that vaccine, and those vaccines coming out, and we getting back closer to a new normal. So I put that up there. And again, if you go back, what's happening to those, and these would be corporate and municipal bonds, corporate more than municipal bonds at this point in time. Municipal bonds have their own special structure going on now with concerns associated with state level finance. So there is that article I put up there. And the other article that I put up there is just again, this week on the COVID-19 vaccine raised hopes of an economic recovery next year. So we are all hoping on next year being a great year. So there you go. And so we will see whether that all happens or not. I'm going to, if you don't have any questions, I am going to turn this over to Enrique, and he can take it away on the midterm.
Yep, sure. Let me just share my screen here. Can you guys confirm that you are seeing that? You should be seeing now the outline over here. Hang on,
Yes,
in my chat box.
thank you.
Yes, yes. Yeah, I'm still looking here. Hang on just a sec. Oh yeah, there you go. Now I see the chat box. Okay, thank you guys. So we're gonna go over the midterm over here. First I'm gonna walk you guys through the multiple answer part. By the way, I forgot to check, and I should, but you should be able to see like the answers and like which answers you got right or wrong. If not, I'll double check that after class, make sure that it's available to you. But overall, you guys are pretty good on the open-ended question. The average here was around 92. It's like approximate. And then the multiple answer part was 82. However, the greater portion of the grade was the open-ended. So I think on average, you guys did a good job. Okay. So I'm gonna go over here, and if you look at Compass, you have here under this week 12 discussion, there is midterm 2 multiple part key, an Excel file, so you can open that. It's the file that I have open here, and I'm gonna go over the questions. And if you guys have any questions related here, just please stop me or type something in the chat. I'll just make sure that we are on the same page here. And as I go through that, one of the goals, hopefully if time lasts by the end of the class, after we go over midterm 2, homework 9, after that, hopefully we're gonna have time, I think we will, and we're gonna be doing a brief review of the first part of the course. I think this is gonna be specifically helpful for you in putting your project together, right? So we're gonna be doing that, and I don't know if you're gonna have yet a review for the final, but assume that this is already a review on bonds and the second part, and then after we're gonna be talking about the first one. So if you have questions related to that, something that wasn't clear, feel free to interrupt me as well, okay? Okay, so can you guys, is that small? Do you guys want me to blow that up a little bit more or less, or how is it? Can you guys read it? Thumbs up or yes? Thanks,
Yep.
Jake. Okay, so question 1 on the multiple part, and by the way, this is 1, but I guess when you answer that, probably like it was mixed or random assigned, but they're all there, okay? First question, we gave you this table, which was the spot rate here on 10 years. And we asked what is the type of this yield curve here on this table. You should be able to see that it's increasing, right? You could have plotted or just eyeballed here, but you would see here that it's increasing, right? And so that was a very straightforward, I guess. This is an increased curve, the answer here for the question. Then still based on that spot rates, we ask you, what is the forward rate from year 4 to 4.5? Now, one thing to note here, just so you guys remember, you will see the notation on the forward rate, like something like this, 4 4.5. And this is what we asked. This is referring, if you're going to look at the table here, to this period, 4.5 period, or 9th here on semi-annual periods. And it's fine if you didn't use the fourth, because the rounding here is going to be very similar. But just so you know, okay, so this, if you did the forward rate calculations here on that column, you would be looking at the 4.5 forward rate. And to do that, I have it here. You would use this formula. If you guys remember, the formula that relates the previous and like 2 spot rates, and then the periods of those. And by using that, you should be able to find this 0.005. Okay, so I'm not going to pull the slides here, but I think you guys remember, right, the relationship between the forward and spot rates. So you should be able to find this 0.005, okay, on the forward rate. Okay, question 3. Based on the spot rate, still the table, what is the price of a bond with a 2% coupon rate and a 2-year to maturity and $1,000 par? So this is straightforward, I would say. It's same thing that we did on the homework, right? Yeah, so won't let me do that. So let me just have it here. Yep. So in order to do that, remember, bonds, they are the discounted cash flows, or discounted future cash flows that you're gonna get, right? This is the price of the bond. So in order to do that, you would set up here the table here, right? As this is how we have been doing it, and projecting its future cash flows. And because it's a $1,000 par and a 2% coupon rate, remember the coupon payments happen semi-annually. So we have here semi-annual periods. So par value times coupon divided by 2. So in each period, you're gonna be having $10 as a coupon payment. And on the very last period, remember, 2-year to maturity, 4 semi-annual periods, you have the coupon plus the par value, so 1,010. Now, to discount those future cash flows, if we gave you the yield to maturity, you could use that. But since we didn't, and we said to use the spot rates, you should be able to use as a discount rate here the spot rate. And what I'm doing here, this 0.17, I'm just referencing here. This is the 4 semi-annual periods, the initial semi-annual periods that we are going to be using to discount these cash flows to present value to find the price of the bond. Okay. Now, if you do have both the yield to maturity and spot rate, theoretically should be spot rate, but if you're looking, they should yield the same result. Okay. So you should be able to discount that, find the discount factor, and then multiply the discount factor by the cash flow. And the sum of those discounted cash flows is going to be equal to the bond price here, 1,037.54. Okay. So I hope, I don't know what is the breakdown by questions, what questions were you guys got the most right or wrong or whatever, but this should be straightforward as the homework. Okay. So find that price over here. Now, question 4, you calculated the price of a 2% coupon rate, 2-year maturity, $1,000 par. It's referring to that question. So if you didn't do the question yet at that time, you should be able to do that and then and then you already answered the next question. So either way, it's asking for the yield to maturity here of the bond, right? And to do the yield to maturity, you need the cash flows. And remember, the yield to maturity is the rate or the yield or the discount rate that would make the future cash flows equals to its price, right? So if you have what you paid for the bond, and the future cash flows, you should be able just to run the internal rate of return formula. And remember, because those are semi-annual periods, multiply by 2 to make it on a year basis. And therefore, you should be able to find 0.12%, right? And so yield to maturity, remember, it's the internal rate of return or the way the discount rate that will make this future cash flows equal to the bond price, okay? Question 5, still on the first table. What is the price of a 10-year principal strip bond with a $10,000 or $1,000 par value? Now, what you needed to know here, it's what is a principal strip bond, right? And I got some questions. I think that was on the open-ended, but remember the principal strip bond is, so you have the regular bond, and imagine that you're going to strip the principal in one side and the coupon in the other. And the principal side of that, the principal strip, you just have the principal. You don't have any coupon payments. So I got a lot of questions. What is the coupon rate that I should show you for that question? So if it's a principal bond, there is no coupon payments, okay? And therefore, the cash flows, if you would do the cash flows, you would just have the price you paid, a bunch of zeros, and on the maturity, you're gonna have the par value back, okay? And so in order to calculate that, you could have done the same here, but I just put that in one formula here, using the spot rate, right? Remember 10 years, so the very last here spot rate, and you have $1,000 par, and you are discounting that using the spot rate, which, just as a review here, remember, if you have a principal strip bond, the spot rate is equal to the yield to maturity of a zero coupon bond, right? So that would be the yield to maturity. So either way, we are talking the same. So you should be able to use that to discount the very last cash flow, the only cash flow that you're going to be having, which is the par value at the end, and to find the price of that bond today, okay? So hopefully that's clear now. And finally, for this first set of questions here, we asked you to calculate the real interest, given here the expected inflation rate, and then the nominal rate, the nominal interest rate. Where's the real interest rate here? And you should be able to, one of those slides, I don't remember which, plug those into the formula to find the exact number, which is gonna be 1.98%. Now, rule of thumb, like if you're doing that on real life and you're thinking, what is the real interest, real rate of interest? Usually it's a very good approximation just to get the nominal rate. So like, I don't know, it's 5% and the inflation expected is 2. It's gonna be somewhere near like 3%. So you could do that like, you know, as a rule of thumb, but precisely you should plug that into that formula because it's gonna be slightly different. You'll see that it's not exactly 2, it's a little bit less. But just for so you guys know for future uses, okay? So are we all good on the first set of questions here? Doubts or comments or something that you want me to go over again? Can I move on? Can I have a thumbs up or yes or no? Thank you. Okay, so moving on then, we have here a couple of questions that were not related to any of the material, supporting material that we gave you. And first of them, we gave you this sentence, okay? Bond prices have suffered. Sprint is that airline company, right? I think that's that, yeah, cheap flights, right? Bond material in 2025 fell from 96 cents to 77 cents. So price fell. This is 7. Price fell here because Moody's downgraded the company. So remember that relationship as well, right? If credit quality increases, you require less yield to invest in the bond. That was the opposite, right? And the question was exactly that. What happened to the bonds yield to maturity? So the logic here, remember, the downgrading, if the bond has been downgraded, you should require a greater return to invest in that bond to compensate for the default risk. And that greater, return, additional return that you are requiring, it's the same as saying you require more yield. And you should remember that relationship, that inverse relationship with prices and yield, right? prices went down, yields went up. So that was question 7 here. And you didn't need to have this part of the sentence here if you think about, right? Because you know that the price dropped. So it has to be the case. For some reason, you don't know the reason, but yields went up, okay? Now, question 8, it's basically asking the same thing, right? So it's just like different, but it's the same logic here. Suppose the Fed announces that they will raise interest rates. So let me put 8 here. They're gonna raise interest rates, right? What would be the expected impact in the rate because of this, or what would you expect the impacts of the rate increase to be on bond prices? So inverse relationship, yields go up, price go down, okay? Again, this inverse relationship, very important to get for bonds, okay? Now, question 9, interest rates have been decreasing. Let me just do 9 over here real quick. Yields going down. What happened to bond fund returns because of capital gains? So yields going down, price going up, means that you have more capital gains, right? So capital gain increases here. And just a sec here, I got a question. So I thought yields weren't affected because they were bankrupt, similar to the AMC company. Okay, so in that case, when I guess the message here, when you say downgrading, this downgraded here means that, remember that, let me put it over here. You have the bond quality, so AA, A, and then like sometimes you have like A and then small a and stuff, but then roughly have this. Then you have C's and junk. So this is the credit quality of the bond, right? So if they downgraded that doesn't necessarily mean that they are bankrupt, if that makes sense. So they're just saying, well, there is a higher chance of default, but it doesn't mean that they will be bankrupt, you know. It's just like probabilistically, using their model, they are predicting a greater possibility of default. And remember also, default here doesn't necessarily mean like going bankrupt. It doesn't and don't making any payment at all. If you just miss one payment, that might be characterized as default already. So when they downgraded that, it's they just saying, well, it's riskier. So you're supposed to be up to compensate for the increased default risk. I don't know if I made myself clear. I don't know, Gary, if you want to add something, but is that clear, Nish?
Yeah.
Is it? Okay, cool. Yeah. So yeah, if they were like they declare bankruptcy, that'll be a whole different story. Yeah, and then you will be right here in the case. Now question 10 here, what is the default loss with a 7% default rate and 89% recovery rate? Remember the formula here for the default loss. You have the default rate times 1 minus the recovery rate, which is the percentage of money that you would be getting back, you will be seeing back in the case of default. So you should be able to just plug that into the formula and find 0.77% here. Okay. Then question 11 here. So we have 2 bonds, that's for 11 and 12. One that matures, 2 treasury bonds. So remember, treasury credit quality, they are the same here in both. Have one with a duration of 3.8 years and the other one 9.9 years. In both cases here, interest rates have decreased. So let me put here 11 and 12 here, same thing. So interest rates decreasing. What has happened to the price of these bonds? Remember the inverse relationship, yields down, price go up, right? And similarly here, the question on the second one is which one has seen the biggest change? So no matter what is the shape of the yield curve, remember it might be increasing or decreasing, if you have a longer bond, it's going to be more sensitive to yield changes. So if yield changes at 1%, the effect on the long duration bond is going to be higher than the effect on the short duration bond. Okay, so you will see that the 9.9 years bond here would see the biggest change. And again, we don't know if it's an inverse or sorry, it's an increasing or decreasing yield curve, but the biggest change will be on that particular bond. Okay. Then question 13, two corporate notes have the same duration. Now, the same duration, but they have different credit qualities. AAA, and the other one is BBB. So we're talking AAA and BBB. And remember, this is higher, and you have treasury here. So which bond has the highest yield? So remember, as you move up here on the credit quality, you move down, you should require less to invest in that bond, right? So yields are lower. As you move down credit quality, you're talking about junk bonds, you should be able to require a great return to invest in those. So that's this inverse relationship. And therefore, BBB is going to have the BBB here, it's going to have the highest yield in comparing those, okay? Questions here, and you see that all those questions, what we really try to do here was to get you guys to fix that inverse relationship, right? It's not intuitive at first place, but you should be able to get it and that inverse relationship. So any questions about it or comments here on that set of questions? I'm just gonna have a thumbs up here. Okay, to move to the to the next one. No, you're good. Thank you. All right. So moving on, we have here, I'm drawing yet. We gave you this comparison sheet between different bond funds, and we have some questions related to that. First question, so they're all based on the same thing here. Which fund has inflation protection, right? And you should be able to look here at the type or even in the title that you find out which one is a TIP. Remember, only treasuries have inflation protection, this special kind of bond. So that will be this IBRIX fund. Next, which funds have default risks associated? So back in here to our credit quality ladder, remember, all of those over here, from AAA down, all of those have some sort of default risk. You might say, yeah, AAA would have like a very, very low default risk. Yes, but still there's very little default risk there. The only one that we don't associate with default risk are treasuries. So the answer to that question will be all that are not treasuries that will have a default risk associated. And looking here, you have treasury. Maybe that might be tricky, but remember that TIP is a treasury, right, with inflation protection. So it's a treasury as well. So all of those other five here would have some sort of default risk associated, okay? Now, moving on, which funds have the best credit quality? We are just asking the same question, but now differently. So the best credit quality that you can have is treasury. So first three ones will be in that category. They'll be the answer, okay? By the way, all of those that had like those multiple choice thing, we consider partial credit if you missed one of them, okay? So just so you know. And moving on here, which fund's price would change the most if interest rates decrease it? So we will be looking at the longest duration. Remember, the longer the duration, the greater the sensitivity to yield changes. And if there was another one here with like fairly like similar, you might still like not want to say, but this one was completely outstanding here in as far as duration, 17 years against those other like top in 8. So that would be the answer, this second one over here, okay? Which funds have tax exemption? We know that municipal bonds have tax exemption, but then this one over here, it says on the name as well. So those three would have tax exemption. Now moving forward, I am over here, yeah. So between those two here, which has the highest yield? So you got to remember this 4 factors to determine we're comparing yields across funds here. You have the credit quality. In that case, both are treasury, so the same. We have tax exempt or not, both are taxable, so the same. And we have inflation protection, both are not, or doesn't offer any inflation protection, so same. The only criteria here that would define that would be then the duration, right? And you might say, yeah, but I don't know if there is an increasing or decreasing yield curve. However, we said here, consider a typical increasing yield curve. Therefore, the longer duration, the higher the yield in that case. Should be picking the second one here, okay? Now, same question, which one has the highest yield between now this one and this one over here? Now we have to look at different things, right? Okay, credit quality, this one has a higher quality. So you would expect a lower yield on the first one. Okay, so first one should expect a lower yield based on credit quality. Now, both of them are taxable and neither one of them offer inflation protection, so the same. And now we have duration. And the longer the duration, the higher the yield. So you would pick this one because it has a higher duration, so you expect yields to be higher, and it's lower here on the credit quality. Again, higher yields as well. So in that case, you should pick that one as a higher yield, okay? Now, between those two, same question here, and now we're looking at two corporate, although like slightly different credit quality. Both of them no taxable, or without any tax exempt. We don't have any inflation protection on both. We have this one having a higher duration. So in a typical increase in yield curve, you'd expect it to have a higher yield and a lower credit quality. So you see here, it holds, this fund here holds a little bit, we don't know the portion, but of Bs or double B, B, and Cs. And this one, the lowest one that it holds is triple Bs, which are higher credit quality, and therefore those here, this fund here should have a higher yield in that case, okay? Now finally, 22, between this one and this one, which one would have the highest yield? So credit quality, both treasuries, right? So same. Both don't offer tax exemption, same. So there are two criteria here that will define that. This one in the right here has a longer duration, so we would expect it to have a higher yield. However, it also offers inflation protection. And remember, if you have inflation protection, you should expect lower yields for that. So in that case, you cannot determine. Although if you put this one, that's okay as well. Probably this higher duration would outweigh this inflation protection differentiation or differential in the yields. So if you choose this one or said cannot determine, both of them will be okay here, okay? So that this is the part of the bond fund comparison sheet. Are you guys okay here? Any comments or questions? So I'll move on here to the next one. So I have 3 questions left. First one, what is the bond price? Yes. The green lines here. What is the bond price? Present value of bond future cash flows. So this is the present value or discounting, same thing, synonymous. So this is the definition of the bond price. Question 24, what is the immaculate duration of a treasury principal strip with a 10-year maturity? For this one, you could have done all the calculations. However, remember the definition of the immaculate duration, the weighted average of the periods that this bond will make a payment. Now, this is a principal strip. So if you look at the cash flows for that, you're going to pay a price for that, and you're going to be having the par value is the only cash flow that you're going to be having back, and you get that at maturity. So if you wait the periods that this bond will make a payment, all the payments are going to be, the only payment is going to be a maturity at 10 years. So 10 years is its duration. Now, if you did the calculations again, you should find the same thing. But if you're talking about a principal strip, you don't even have to do the calculation. Finally here, last one, treasury bond has a 10-year maturity, 1.5 coupon rate, $1,000 par. The huge maturity is 1%, and it's asking for the immaculate duration in semi-annual periods. So first of all, we can project its cash flows. Remember coupon payments here. So 1.5% divided by 2 times par value. And on the very last period, you have the coupon payment plus the par value. Now, we have here the huge maturity, so you can use that to figure out the discount rate in each period. And then we can multiply the cash flow by its discount rate to find the discounted cash flows. And you might be wondering why we're doing that. It's just because to find the immaculate duration, we have the numerator here, but we need the price to figure out what is it. So I'm first in here walking you guys through how to calculate the price. And the sum of these discounted cash flows is equal to the price, right? And then the immaculate duration, to weight the numerator part of that, you can just weight or do the period that this payment is made times the payment that it's going to be making, or the bond is going to be making, the discounted payment. So you should do that all the way down, and the immaculate duration will be the sum of this weighted payments divided by the bond price that you calculated. Okay, you should be able to find 18.69. Now remember, we are already talking here on semi-annual periods. So it's already the answer in semi-annual periods. Now, if the question was in annual periods, then yes, you would divide that by 2 and get the immaculate duration in annual periods. But in that case, we asked for the semi-annual periods bond. So I guess this is the multiple part of the midterm. Any questions here before I move on to the open-ended part? Or comments, or everything good? All right, thanks. So if you go here on the outline, if you downloaded the outline for this lecture, you should see here the open-ended key. You can just open if you want this Google Docs. And where is that at? Over here. Okay. So the question here, so it's kind of like a story, right? So you bought a 10-year principal strip with a $1,000 par value and a 2% huge maturity in January of 2015. And you don't remember the price you paid for that, but you were able to find the spot rates for, there was the spot rates in 2015, the time that you bought it. So with that, you should be able to use that information. And remember, and this is the one catch here, I shouldn't say catch, but like, remember the principal strip bond has any coupon payments. So if you look at its cash flows, you're paying for the bond, you don't receive nothing, and then at maturity, you're going to be receiving the par value. So a lot of you guys, I guess, assumed like a 1% or 2% or 3% coupon rate. So there is no coupon payments here, okay, coupon rate as well. And when you do that, you can plug here as a discount rate the spot rate in the time that you purchased it, and find the discount factor, and with that, discount those cash flows. And you could have done that in one single line as we did on the other one, because really the sum of that would be just equal the very last par value discounted the present value. So you just needed this very last line to calculate the price, but you should be able to find 18 and 19, $819 that you paid for that at that time, okay? Now, the second question, calculate also the maculae and modified duration in years in that case. And remember, it's a straight bond, so the maculae duration, you don't even have to calculate and know that this is gonna be at maturity. So if it's a 10-year maturity bond, maculae duration is gonna be 10 years. If there was in semi-annual periods, 20, okay? But it is gonna be 10. And with that, you should be able to do that divided by the yield to maturity plus 1, right? And find 9.8 as the modified duration. And we have the definitions here. I'm not gonna go over here. So 10 years and 9.8 years, okay? Now question 3 started, I guess, to be a little bit different than we did, but actually we did that on a homework. I can't remember which one, but so question 3, because of events this year, assuming now that the yield curve has shifted and now we have the new spot rate curve or yield curve in 2020, which is down here as well, right? Gave you. And we are asking here, nothing else changed. What is the price of the bond now? Are you better off today? And you should be able to do the same thing here, but you should be able to look here at the year 5, because remember, you bought that in 2015. Now, fast forward to today, there's 5 years already that went by, and you are now in 2020. So looking at the spot rate today, you can use that to find here your current bond price. So you should be able to do here 1 plus spot rate divided by 2 raised to the 10th here to get the value of the bond today, which is 963. Now, are you better off today? Well, there is definitely some capital gains here. And so if you said that, yeah, the price is greater, I am better off today, that's fine. But a lot of people, I like that when even had and said, well, it was actually higher than the expected price at the time. So that's good too. So if you calculated what would be the price if the spot rate curve of 2015 had been, stable or had been today's, and then comparing to what this is actually today, then you could tell like, okay, I'm really better off because it was even greater than what I expected. So that was what we were looking for here. And finally, we asked you here, let me zoom in that a little bit, just realized that. So you decided that you're not going to be needing those funds 5 years in the future, but 10 years in the future. So like, I can't draw here, I guess, but oh, I can. So you have here 15 today, then 25, and 10 years in the future. So we are here, you bought it here. Now I have 2 options, okay? Hold the bond that you bought in 2015 all the way to 25, and then buy another 5 years here bond, same bond, Christmas tree bond here. Or you could, let me do that in, you could just sell it here and then buy another 10-year bond, same thing as yours here, to have the money here in 2030, okay? So just clear that. That was the problem, right? And we asked you to evaluate that and which one do you prefer, and indicate the risks and considerations in your answer, okay? Assuming that the spot rate will remain the same as 2020. So let's go with option A. You're gonna wait and hold your bond into maturity, 2025. What are you gonna be getting at 2025? the par value, right? Remember, it's a strip. The only payment that you're going to have is the par value at the end. So we are here in 2025, and you got the par value back. You have $1,000. And then you buy another 5-year strip at that time. And the problem here is you don't know, although we have here this par rate in 2020, you can't lock it yet, right? So you should be able to calculate here the forward rate. Remember the implied future interest rate by the market, and kind of roll this future value in even future, even more in the future value using the forward rates here, and you'll be getting this 1,007.64. Okay, so that would be like the value that you would be getting in 2030. Now, if you did it opposite and calculated the present value, that's okay as well. It's fine. You should be finding something else. But point is, but if you do that, the only catch here is that you can't know for sure the par rate, so you should be using the forward rate. If they remain the same, they would be the same, but ideally you would be using the forward rate, and we consider if you didn't, but that's what you should have. Okay. Now let's look at option B. So you're gonna sell your bond today. So you pocket, yeah, definitely some capital gains here. So we have now the price, what the bond is worth it right now, which you calculated in question 3, $963, right? And then you buy another 10-year strip. And the thing here, you can lock for sure the par rate if you buy that today, right? And if you do that, using here this par rate, so the price that you have today times 1 plus this par rate, 10 years in the future, divided by 2, raised to 20, semi-annual periods, remember? You should be getting the exact same value, okay? Now, a lot of you guys said, yeah, I should go ahead and sell it and get my capital gains right now. But one key thing here that you should not be confused about is returns, right? What has happened and what is about to happen in the future. So if you pocket the capital gains or not, I mean, we are looking at a future decision here, right? We are in the same place on option A and B right now. So they're both already have this capital gain embedded in the decision anyway. So I guess this is, I don't know if you guys missed that, but I don't know why a lot of guys asked, like said, okay, I'm gonna have to sell it today, pocket the capital gains, and then buy another one. And the only difference between those actually here is that reinvestment risk that we talked about. So you cannot lock for sure these par rates. You cannot know for sure this par rate that you're going to be paying that is going to be in place 5 years from now. I mean, you have the forward rate that implies that, but you cannot know that for sure. So there is this reinvestment risk, additional reinvestment risk if you go to option A, although they would here have the same future value or present value, if you would, for you. Okay, so if you want to be like really sure, if you should lock it right now and have the money for sure. But otherwise, I mean, this is the only difference, the reinvestment risk. And over here, we consider like a lot what you guys said, you know, your options. We were really looking for that. But if you argued somehow, you know, the risks and, you know, with the logic, rationality behind it, we consider part of that. Yeah, so this was the midterm 2 open-ended questions. You guys have any questions on it? Or you guys okay? Good. Well, you guys can check it later then on Google Docs, the answers, what we wrote. And if you have any questions, you can always get back to us or email us, okay? Now, finally, let's move on to homework 9, the last homework. And we have here the key. And homework 9, there's a lot of things that you guys are, actually not a lot, all things that you guys already did in the past on the first homeworks. So let me just open that. There you go. So for homework 9, we gave you 2 funds and asked you to calculate annualized returns. And we put that as well here. Use GeoMean as return estimate. And you should remember, we're going to be doing this review real quick. But GeoMeans are always preferred over means, okay? And the annualized returns, standard deviations, and correlation coefficients for those funds. So if you look here at data sheet, I highlighted here on questions if you guys want to look later, the steps that you should be doing to get those. First one, I don't know if you guys missed it or not, but you should be able to make sure that those dates were matching, okay? So one of them, I can't remember which one was older. And if you are comparing 2 different dates, you're comparing apples to oranges. So first things first, always let everyone on the same page here, same date, okay? If you picked a different one, that's okay. We're gonna look at that, but they should be matching here, first of all. And then I'm going to calculate the standard deviation first. In order to do that, I am calculating here the daily returns. So first date here, you just invested. You don't have any returns yet, but now the second day, you have the returns. And it's very important here. If you do have that, you're gonna be using the adjusted close price for that, right? So remember, it's already like part of the review. So when you're talking about returns, you're talking about 2 different kind of returns, right? Capital gains and current gains, or dividends, interest, or any sort of current gains. But if you look at the adjusted close, it's already adjusted for that. So you can just be using this as a measure of total return, okay? So you do the current price divided by the previous price minus 1, and you got the daily returns here. Double click or copy and paste it all the way down. Just make sure that they're all here. And the same thing for the other fund. And here I have the daily calculations for the standard deviation, which is just the standard deviation of those returns, okay? Same thing for the other one. Now, for the GeoMean, let me just calculate the GeoMean. Remember, guys, there's 2 ways to calculate the GeoMean, right? One of them, you would add 1 here to all of those returns that you calculated, and then you would use the GeoMean formula over that interval, and then subtract 1. But guess what? You probably, if you did that, you got this error here. And remember, the GeoMean formula here, when you use that on Excel, has a limit on the amount of data that you can actually compute that. So you wouldn't be able to do that through that way. However, you have here the adjusted close price. And what you can do is use that formula here, the last adjusted price or adjusted close, so down there. The very last one divided by the very first one, and then you're going to raise it to 1 divided by the number of periods that are there, minus 1. And the number of periods, the count of periods, I did it separately here, and there's just a small catch. So remember, if you have 5 periods, 1, 2, 3, 4, 5, you just have 4, let's say, interperiods here, or periods variations here. I don't know how to express that, but the point is, that's why when you count all those days, you should subtract 1 in the end. So you're looking at the daily, and you have 8,687 daily intervals here, although you have 88 days, right? So always take 1. And doing that separately is probably a good idea, so you don't end up with a very huge formula. But then you're going to raise it to 1 divided by this count of periods minus 1 to find here your daily GeoMean, and then I did the same for the other one. But the question asked for the annualizing mean or return, right? Geo mean and standard deviation. To annualize that, should draw me here. Yep. Okay. So in order to annualize it, you should be able to use that formula 1 plus the daily geo mean in that case, raised to 251, because this is daily data. So this is 251 trading days in the year minus 1. Now, something here that you should be aware of, if for the asset tracking, you're trying to compute, or you are going to compute the whole period, average geo mean for the whole period that we are tracking those assets, remember that those are weekly returns, weekly prices, sorry, right? So you should be using as N52 instead of 251. So remember that, okay? So I did here analyze both geo means, and for the standard deviation, the process to annualize it is just multiplying by the square root of N, in that case 251. So this is just multiplying here by the square root of 251. Finally, correlation here, you can just use, if you use zeros, okay, as well. It shouldn't change. And there you go. Okay, so paste that here. Now, so far so good, guys. You guys have any questions or comments here on the first question on homework? Pretty much like what we did in the past, but maybe you guys have forgotten that by now or not. I don't know. Is that okay?
By the way, this is what you're going to be doing for the project too. So, and actually for the project, when I write up my version of the project, I'm using these two as my my example portfolio. So there you go.
Yeah. And then for the portfolio here, we ask you the second question to put those in a portfolio. So this is just a 2-asset portfolio, but in your project you can use more. But then ask for the portfolio returns, the expected returns and standard deviations of that portfolio. Now, there's 2 ways that you can do that for this 2-asset portfolio. You could have just used the formula here, and remember the returns of a portfolio here, it's simply as the weighted average of those returns. It's very straightforward, this thing. So the weight, how much of your portfolio is composed by the asset times its returns, and so forth. So but you could use the formula here to figure out those expected returns. Now, the standard deviation, there is more to the formula, let's say, and that's the beauty here of you having a diversified portfolio, right? You have this diversification benefit. So it's not just the weighted average of the standard deviation. So there is correlation also between those that matters here. And you could have used that formula as well and changing the weights and doing that. Or I'm gonna go on the second version of that just quickly here. So for the project, we are pretty much doing the same thing as homework 9, but using different funds. I don't know, Gary, if you wanna address that again, but basically yes. Although you can put other funds, not just 2, and you can put other, actually you can pick stocks if you want, or something else.
Yep. No, the more, and so, and we'll talk about this some more next time, but you can put more stocks or more assets into your portfolio. Obviously, the more, it's not much more work, but every time you add a little bit more to your portfolio, you have something additional to add. You know, and you know, you probably would want to think about an international fund, for example, would be a good thing to think about. You might want to think about splitting up and putting some having a bit more risky fund as well. For example, put a mid-cap growth in there. So all of those things you can look at and, you know, fine tune your returns and perhaps get a little bit more diversification benefit there as well.
Yep, definitely. Does that answer the question, Jake?
Yeah, yep. And Jake, you're exactly, that's a long way of saying yep to your question. We got to be a little bit more wordy than that, but yes.
Yeah, so yeah, cool. Now, the second way here that you could have approached that problem is, instead of using the formulas and plugging in here, you could have go back. And by the way, you have that for yourself if you want, right? From now on, we have that two asset portfolio sheet ready for you, and you could have just here come and plug those means over here, standard deviations over here, correlation coefficient over here, and you have here weights varying by increments of 5%, and you have here the expected returns of those portfolio, that portfolio, and the standard deviation of that. Now, this is the same formula, okay? So what this table is doing, it is calculating here. So we have those two formulas over here as well. So either way, you should have the same results. If you did this, you would have here to pick those cells in yellow and paste the standard deviation and expected return over here, okay, to form that portfolio. And something else I just did that to illustrate that, but that you might think on your project, I think this is a very real example and very good example in showing the diversification benefit that you would get. So if you guys remember the Sharpe ratio, right, the adjusted returns by the excess returns adjusted by its risk, you would see here the shape of this Sharpe ratio. There's clearly one configuration here, one set of one combination of those assets that would yield you the same return, or the highest return for adjusted by its risk. So the greatest risk reward ratio, reward risk ratio. So I think this is a very good example of this combining assets in a portfolio here. And by the way, if you change the risk-free asset, you would change the Sharpe ratio, but the shape of that wouldn't, and it wouldn't change the returns here in the standard deviation, okay? Now back in here to the case, the homework, sorry. We asked you, what would John Bogle say a 50-year-old should invest in those assets? And remember, Joe Bogle basically says, as a rule of thumb, that you should hold your age in bonds and the rest of that in equities. So if you have 50 years old, half of, or 50% in bonds, 1 minus 50%, right? 50% as well in the other fund or equities. Now, if you were 30 years old, according to him, you should hold 70% of this Vanguard 5 or the S&P 500 fund, and and then 70% of that and 30 in the bond fund. Okay. Now, given the results, that was your personal question. Would you ever hold 100% of the bond fund? You might think, yes, if I had like 100 years. You might be right. I mean, if you're according to that. Okay, although if you know that if you put a little bit of the other fund here, you can have a greater return for the same or less risk. Remember the Sharpe ratio. So basically what it's saying here, it's, well, if you hold 100% of the other fund, you are here. So now why not decrease risk and increase returns and hold this optimal portfolio here, right? So that was a possible explanation for that when putting those together. Although if you're very risk averse and you want to hold 100% of that, that's up to you, right? But this is our answer here for that. If you answered yes, if I was 100 years old, that's fine as well. We're gonna consider that. So that was homework 9. Gary, do you have any additional comment on here, or?
No, I thought you did a really nice job there. So if there's no questions, that's what we were looking for. Again, that was review. Should have been review. We did this before, and you're going to do it again for the project. So
yeah.
One of the reasons, by the way, that we do this, why you know, you could go and look at the prospectus and get the returns from them. The reasons why, one of the reasons why to go to Yahoo Finance is to make sure you're looking at a comparable period, right? Because if you don't, you're not necessarily looking at a comparable period. And number two is those correlation coefficients are just so critical to understand, and no website really gives those. So you can go download that data, and Enrique's going to
Well,
do a
sure,
little example on Python where it's much easier for you to do it. But you know, just coming up with those correlation coefficients, just remember that when you're looking at portfolios, and you got a portfolio, you got this person with this portfolio, you know, you want to add assets to it that have low correlations, because if you're adding a correlation asset with a very high correlation, you're not doing much from a risk diversification standpoint. So that's what I have to add to that.
No, cool. Yeah, and finally here, what I had here it was just touching points on some items that we talked on the first part of the course. So I don't know if you're gonna have time to go over all of them. I don't know, Gary, if you wanna leave that for the next session, or do you want me to go through that?
Let's just do that. We'll do this at the next session, and we can also
Okay.
record that as a module too. So look forward to that on the module. So.
Okay, so I guess sounds good. Then,
Ah.
I think.
Hold on. I got one thing. Before you all leave, I got a poll for you for sticking around. Let me see if I can do a poll. Where'd my poll button go? Oh, there it is. I got it. Here's my poll. All right, so we're playing college football now with and this is not this year, this is next year, 2021. You think we'll be back to normal? So I'm asking you this. Will we be playing college football in 2021? And there's obviously no answer. I want to know your guys' opinions here. And we'll show you the poll here in a minute. Because this is sort of getting at, do you think we're going to be back to normal by this time next year? All right, I'm going to end the poll here. Share the results, and here's what 6 of you said. All of you said yes with restrictions, which is probably about right. I don't know. Enrique.
That's your opinion as well?
I'm hoping. Yeah, you were right. We were wrong on the last poll. But, hey, that's why you do polls. It's not scientific. So, all right. I'm going to stop sharing. Okay. It's almost time for us to end here today. You all have a good Thanksgiving, and we will talk to you after break, and I'll post some modules up there, and I'll send you emails when they're up there. So you all have a good break.
Thank you, guys. See you.